Well, if you have been shopping for a home and a mortgage in the past couple of years, you'll know that your money doesn't go as far as it did because you have to qualify at a rate that is above the actual mortgage rate that you pay. And for some who were frustrated by the rapid rise in housing prices in this country, that was seen as an encouraging step, a way to cool down a hot market. But the beef we often heard from industry players and some consumers is that the math would not add up when it comes to what's actually happening in the mortgage market. At the center of this story is the Bank of Canada's posted 5-year rate. You might have come across that online, or if you're doing your mortgage homework at a bank branch. Generally speaking, that is the rate that comes in well above what the banks end up charging you to borrow money over 5 years. So the finance minister's conclusion, our big story that started developing yesterday, let's find a way to base the stress tests in this country on a rate that is more in line with the market dynamics. In other words, lower. So consumers can have a little more money at their disposal to buy a bit more house. If you've ever been in a bidding war, you'll know a few $1,000s can certainly help. This decision was based around insured mortgages, so those who are putting down less than 20%, but it could eventually extend to uninsured mortgages, which is a bigger market. Of course, the question is whether or not this adds fuel to the housing market, heats things up as we get ready for the spring shopping season. Let's get some more perspective on what lies ahead. John Pasalis is the president of Realosophy Realty and one of our regular guests on the subject of housing. Nice to see you.
Good to see you.
So what was your reaction to this decision yesterday by Finance Minister Bill Morneau?
I mean, it's a smart move. I mean, I think really what they're doing is just really kind of correcting the way the mortgage stress test was originally set up. Because what's happened in the past, say, 2 years, is that the interest rate that buyers are paying on 5-year mortgages has actually dropped by about 45 basis points. But the qualifying rate is actually up 5 basis points. So the stress test ends up being about a 250 basis point stress test when they really wanted it to be about 2%. So they're really just kind of correcting that and allowing the stress test rate to sort of react to current market dynamics.
So the stress test rate now is going to be a little more active, right? It's calculated more frequently to try to be closer to what really happens when you go out and try and get a mortgage?
Exactly, and that's one of the problems. So one of the problems is that, you know, when rates drop, we want our housing markets to be able to respond to these lower interest rates, and it wasn't because they're effectively pegged at the Bank of Canada rate, which was a little bit inflated right now. So by making it sort of a little bit more dynamic based on what people are actually paying for mortgages, then the market can respond dynamically to sort of changes in long-term rates. So
I mentioned that this is tied to insured mortgages as opposed to uninsured mortgages. So we're talking about people who are putting down less than 20%. 20%. There's a fair number of Canadians who are doing it. It's generally speaking a smaller part of the market. Does this also suggest we'll see uninsured mortgages follow the same guidelines going forward at some point?
It does. I mean, our banking regulator, OSFI, is looking into that, and they're planning on potentially, it looks like they will be sort of moving in the same direction. They haven't made that change yet, but it looks like that's kind of becoming in the short term.
And this is all coming as we get ready for the spring buying season. We had talked on BNN Bloomberg about the fact that, you know, the story coming out of Ottawa, that the Prime Minister was sort of alluding to something happening. How many different ideas, I guess, could they have explored to try to go back to the drawing board and say, look, we want to make sure there are some good measures in there, but we got to find something that works a little bit better?
You know, I think there were other options, but I think that the federal government probably didn't want to ease the stress test too much. I mean, they are still concerned about rising household debt. And really this isn't, I mean, although technically it's kind of loosening credit a little bit right now and a bit of a demand side stimulus, it's really more of a correction in the way it was set up is kind of, I think, what's happening right here. It's not so much that they're loosening the stress test, it's just they're kind of modifying the way it was originally designed.
Because you're still going to be measured at a rate that's above the rate you get.
Exactly.
It's just that we're going to kind of be closer to basing that off of the realistic rate and then adding a little cushion on top of that to see if you can make your payments.
Yeah, and some industry players have been kind of pushing for a much lower stress rate, you know, 1% rather than 2%. You know, again, this would just fuel a little bit, quite a bit more debt, and I suspect that's why they didn't go that route and just decided to focus on making it a little bit more dynamic.
I mean, you're well aware of the dynamics in the housing market. Does this change, even if it's more subdued than some of the other options that could have been on the table?
Yeah.
This is still going to put more, you know, theoretically thousands of dollars of buying potential into the pockets of some home shoppers?
Yeah, probably about 3-4% or so is going to increase people's budgets. So, I mean, even that little bit in competitive markets like Toronto does impact what people can spend. So it will provide a little bit of stimulus on the demand side. Not the ideal time for Toronto's market because it's very competitive.
Yeah.
But again, these changes can't be tied to what's going on the ground in a particular housing market.
Well, I wanted to, does Toronto need more demand or does it need more supply?
Yeah, no, I mean, that's the problem with Toronto. Toronto's unbelievably competitive right now. Supply is very tight. Demand is through the roof. So it doesn't really need even this little bit of stimulus. But again, they can't really tie these policy changes to what's going on in Toronto. Right?
I mean, at the end of the day, as an observer, do you think this was the right move when we're now once again getting back to a question about whether this adds a little bit of fuel to the housing market?
Yeah, I think it was. I mean, I was against sort of changes that ease the stress test significantly because I don't think we need that. But again, I do think this is a smart move because, again, it allows the market to respond to changes in 5-year rates, which it wasn't able to. It was effectively like pegging our 5-year interest rate or the qualifying rate at this artificially inflated price and not allowing to the market to change the 5-year rates and dynamically adjust to it. And I think that's what we're doing now, and I think it's a smart move.
One of the other things I heard, Andy Bell and Greg Bunnell were discussing this yesterday as this news broke, was how much flexibility home shoppers / mortgage shoppers had to shop around for the best mortgage product. Mm-hmm. The fear out there that once you've gone through the process of qualifying through the stress test, that if you felt like, gosh, I don't like this, that it felt difficult to go and go across the street to another bank to see what rate you might end up paying there, because you would have to potentially go through that mortgage stress test process all over again? But
potentially, yeah. I mean, most people, what they'll do is they'll sort of vet a couple of different mortgage lenders and then do their pre-qualifications with one, and then usually go with that lender at the last minute. I mean, technically, you can still shop around a little bit for rates, but you're right. I mean, you have to go through the entire application process all over again. And we don't know how that's going to work. I mean, the rates that the Bank of Canada is going to be using going forward is going to be changing weekly, right? And we don't know what that's going to look like. I mean, I'm assuming if you qualify for a mortgage today, they'll be able to lock it in for 60 or 90 days. But if you sort of try to requalify 90 days from now, my assumption is it's going to be at that time's kind of posted rate, which might be a little bit higher.
Interesting. So how many insured mortgage market participants could ultimately be impacted by this? I mean, how big is that part of the market?
I don't think it's going to be as big as most people think. Again, this is really just going to impact people who are buying at the absolute margin. And what we see is a lot of people don't always end up buying what they qualify for. Sometimes they end up buying a little bit less or put a bigger down payment. So I don't think it's probably going to have some impact, but not as much as some people might think.
The home price sort of environment. What's been the biggest factor? I know Toronto has its own factors, but for those who, I mean, we're having a different conversation today about housing than we did when the stress tests were implemented.
Yes.
Right? I mean, things have changed.
Absolutely.
So what have been the biggest dynamics behind the housing market, let's say, this year, last 6 months or so?
So in the past 6 months, the biggest dynamics right now have been the market has completely rebounded from the stress tests. So the market's kind of adjusted to them. Demand has picked up significantly. And the big thing that we're seeing right now is we're seeing a lot of competition in this almost like speculative mood in the condo market. Very tight demand, very strong demand, very tight supply. So there's not a lot of condo units available for sale, and largely because investors are buying them and people who own them are holding on to them. So there's not even a lot to choose from.
Well, but speculation and investors in real estate, you're saying the things that I thought the mortgage stress tests were there to get away from people playing the speculation game.
I mean, in theory, yes. I mean, but I think a lot of people have built up a lot of equity over the past 10 years. So if you bought a condominium 10 years ago, it's gone up significantly. A lot of people, what's happening is they have so much equity, they're able to upsize to their next home and not sell their existing unit. So I don't know if I'd call this speculation. I mean, this is people who are just holding on to them as investment properties, right? But what it's doing is it's taking a lot of the potential supply for people who want to move into them and is just transferring this inventory into sort of the rental stock.
Is there